If you love monthly dividends of 7%, including a special dividend paid out every few months, then Main Street Capital has to be on your watch list. We're going to take a look at this company. We're going to analyze their top line revenue growth as well as their bottom line net income year on year. We're going to review the health of this company, their total cash versus their total debt. We'll see how well they're performing against some of their well-known competitors in the industry over the last 5 years. And we'll look to the institutions to see whether or not this is one they have been adding to their portfolio. We'll discuss a little bit of insider selling that we have noted over the last few months. And we'll take a look at their dividend safety. We'll run through some very important financial metrics. And as always, we'll run them through our valuation model to get to our intrinsic value as well as our acceptable buy price, giving a look at what Wall Street are targeting for the next 12 months. Now, for those that have heard this company for the first time, Main Street Capital is a BDC, a business development company. And the way it works is they offer financing, as we can see here, to small and middle market businesses. In return, they get interest and fees. And what they then do is pay that in the form of dividends to their investors. So this is a BDC for future reference. Now, in terms of Main Street Capital, more specifically, we can see they have around 7.2 billion of capital under management. And what they offer is debt and equity capital specifically to companies that look to support management buyouts, refinancing and acquisitions of other companies. So let's jump into our analysis. Now, this is up around 11% over the last year. And over the last 10 years, we can see up 54%. Bear in mind, this doesn't include those dividends reinvested on a monthly basis. They are currently trading towards their 52-week high. Now, we do see their starting yield of 6.25%, but bear in mind that doesn't include their special dividends that they offer every few months, which would take it over the 7% mark. And we can see a forward P basis of 11.34. So in terms of their top line growth, what we can see here is around 243 million in December 2019. And in their latest annual report, 500 million. So we can see their total revenues more than doubled over the last 5 years. On a more granular level, what we see is it did drop in 2020, but since that point, their top line has been increasing. And we can also see here at their bottom line net income, 130 million, and a very similar story, strong growth to 428 in 2023. But again, a little bit of inconsistencies with the drop in 2020. It did pick up and then dropped again. But over that longer term, we do see both on the top line and the bottom line increases year on year. A quick look at the health check. Now, total cash versus total debt. 55 million worth of cash and short-term investments in 2019. We see in their latest quarterly report around 60 million. So when we compare that to their total debt, what we can see numerically and directionally is it has gone up from around 1.1 billion to around 1.8. Now, they don't hold a lot of debt, and we will also talk about this when we come to look at their financial metrics. As with a BDC, we do need to look at these slightly different than normal companies. Now, in terms of how they've performed against some of their competitors, we have Ares Capital, Gladstone Investment, and a few well-known others. Over the last year, now this includes those dividends reinvested, we can see they're in the mid part, around 19%. Not too bad, in all honesty, over a 12-month performance, but we can see there are some other funds which have performed slightly better, MFIC, TSLX, and GAIN. Now, over the last 5 years, when we take a look, they are up around 69%. Again, one of the worst performing, but we do see the industry as a whole has performed fairly well and fairly consistent around that 60 to 100% mark. So not too bad, but again, different investors will have different horizons, different goals. So do bear in mind one important thing here, that past performance isn't an indicator of future performance. Now, institutional ownership does sit around 20%. 50 million worth of sales by these institutions over the last 12 months. Over the same period, more than 3 times buying, so we can see institutions are very bullish on this company. And if we look pretty much for the whole year of 2023, more buying than selling, with the green depicting the inflows, red the outflows, and also in the latest quarter. So we can see you'd have to go back all the way to Q1 of 2022 to see where institutions were selling more than they were buying, and in fact that was only marginally as well. So institutions are bullish, but remember, please always do your own due diligence. Now, what we like to do is run these companies, their ticker symbols, through the insider buying and screening market just to see what is going on with insiders. What I would say, whilst we do see insider selling here, for those viewers that are new, insider buying is a bullish signal. Management buy because they believe the share price will go up. Insider selling, not that bearish because they do sell for many reasons, whether that's personal or financial. Now, we've just gone back 3 months. Typically, we like to look at around the last month, but just to be transparent, the managing director, Nicholas M., did sell around the 20th of December 23, 6,000 shares, $43 of around $258,000 worth. Now, what we would say, as we can see, this is why we don't necessarily see it as a bearish signal. The share price since then has risen 7%. But as always, we do just want to keep transparent to show you when last there were buys or sells. Now, before we jump into the financial metrics, just to let you know, we have released our latest free weekly newsletter article. If you want to gain access to that or any of the other articles completely free, including my 7 golden dividend metrics to find undervalued companies, do click on that pinned comment below to sign up. Dividend safety score, we have 62. It does look to be safe. Market cap just under 4 billion. It is a mid-cap company. Now, in terms of those recessionary metrics, well, they maintained the dividend during the 07-09 recession. They had above average growth, although marginally, negative 7.5% versus the S&P's negative 12%. But they did significantly outperform the S&P, negative 25% versus the S&P's negative 55%. Now, dividend growth, a little bit mixed, 2.1% in November last year. What I always say, you want a minimum of 4%, and I advocate that on the channel just to keep up in line with inflation. Over the last 5 years, they have obtained that, as well as the last 10 years. But I would also say for November 23, and we're about to see, they do pay special dividends around once every quarter, so that should be a little bit higher if you factor those in. Now, they have also been increasing those dividends for the last 13 years consecutively. So as we can see here, these special payouts, they do pay special dividends. In fact, if we just look at 2023, every quarter we do see a special payout. March 27, 2024, they are expected as well for a special payout. So let's take a look at dividend yield theory. Now, it states a company is undervalued when the current yield sits above the 5-year average. Now we have a slightly different scenario. It is slightly lower, so you could argue reasonable valuation / some slight overvaluation. But we'll take a look towards the end. We don't look at any of these models in isolation. And in fact, the forward PE is showing signs of undervaluation at 11.4 versus that 5-year average of 15. We can also compare the sector PE. It is pretty much bang in line with financials of 11.4. Now, with these type of companies, BDCs, we don't look at the free cash flow as that is a lot more volatile. We do draw your attentions, unlike other companies, to the earnings. We want to see below 95% for these BDCs, as we explained earlier what they are. Now, what we can see over the last 3 years looking fairly positive, below that 95%, and 2024 at 71%. One thing I would say going for the future, whether it's on this company or others, if you see over 100%, this is a red flag indicator as it signals management paid out more in dividends than they generated in earnings. Given that was 2020, there was the pandemic, there were other issues. We can say that since then it has looked a lot better, and even 2024 at 71% is looking fairly healthy, but just something to consider moving forwards. Earnings per share, nice to know, it has nearly doubled over the last 10 years. Not extremely consistent, but if you are a long-term holder of most stocks, you can see it is looking positive, although we do note 2024 is expected to dip slightly. In terms of the earnings per share growth, well, it has seen some phenomenal growth over the last 3 years, strong double-digit, 24 to 26%, so that it is looking very, very nice. But again, always do bear in mind that they do go through periods where they have minimal growth and also negative growth. We can see 2024 expected to drop as well, so do bear these in mind, especially when you're looking at your investment thesis and the margin of safety that we're about to come up on. Sales growth then, we can see very strong double digit over the last 3 years, looking very positive. But one thing I do want to mention that we didn't touch upon earlier when looking at the sales figures, business development companies, they don't report revenue like the other companies that we do run through. What they typically report is their total gross investment income from their interest and their fees. So if you remember that graph that we did discuss earlier, the way that they do generate their income is through financing, and then they in return get those interest and fees. So that is typically what we're talking about here. And then we can see consistent, effectively, growth shows that the BDC has been able to find opportunities to grow its portfolio, as we can see here over the last few years. Numerically speaking then, their top line has increased more than 3 times. It does look very positive. But this is one thing we want to point out, shares outstanding. Now, we prefer it personally when companies do share buybacks, returning excess cash to our pockets. Now, what we can see here, due to their high payout ratios, BDCs typically have to borrow money and issue shares, as we can see in the graph below, to grow their business. The whole point here is what you want to make sure is that the EPS, the earnings per share, is growing at a much faster rate than the issuance of shares. Otherwise, they're not just growing for the sake of growing. So a few things just to bear in mind for those that are new to BDCs. ROIC, as always, one of my 7 golden dividend metrics. While typically 10% or more, for BDCs we're looking at around 8% or more. Over the last 10 years, it has been straddling around that 7 to 8%, so it isn't too bad. Nice to note, 2023 at 10% is looking very strong. Now, the other metrics that we typically look at in other companies, the operating margin, free cash flow margin, as well as the net debt to EBITDA, is unfortunately not relevant for Main Street Capital. The reason for this is that interest is a core component of their revenue and expenses. So let's jump straight into the valuation. As always, if you do enjoy the content, value being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So for today's episode, we're just using 2 of the 4 models that we typically run through. The first one, we have the multiples valuation. Companies in a similar sector and size that we analyze, we have their earnings per share, their PE. We get the average P multiplied by the EPS of Main Street Capital to get an intrinsic value showing a first sign of undervaluation. Just bear in mind we don't look similar to the other models at any of them in isolation. So the second one and final one is the DDM model, the dividend discount model. We have the growth rate now. It has looked fairly inconsistent, but over the longer term around that 5% mark. Now, I have gone a lot more conservative. Don't forget this company also pays out special dividends, which will alternatively increase that starting yield over the longer term. So we get to an intrinsic value of $54, which is higher than the market value, so another sign of undervaluation. So the intrinsic value for Main Street Capital in today's episode is the average of these 2 models, coming to just over $56. Now, don't forget you can click on that pinned comment below if you do want to grab a copy of the valuation model, so you can also get to the intrinsic value and acceptable buy price of companies, whether it's your own portfolio or whether it's companies on your watch list, or even if you want to run through Main Street Capital with your own estimates and judgments. So we start off with a margin of safety of 10%, which we use if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. We can see with that is a buy up to $51. At 15%, a buy up to $48. And at 20%, we can see it isn't quite there yet, but not too far. So we see a 15 to 20% margin of safety for Main Street Capital. Now, in terms of Wall Street and their forecast over the next 12 months, they have a price target of around 4% at $48. Now, whilst this isn't too high, you would be looking at an upside of 4% if you were to rely on Wall Street, which we would never ever say that you should. What we would say is don't forget you are getting a fairly strong starting yield of around 6.25%. Then on top of that, when you include those special dividends, this is one that pays a very nice dividends monthly. And finally, what we would want to show is that over the last year as well, it has been performing very well, up 11%. As always, let me know your thoughts in the comments below, whether or not this is one you own. Maybe it's one that you own but you're waiting for a pullback to add. It does look like to be a very strong company with some very nice yield. But again, this will all depend exactly on your margin of safety, whether you are looking for a higher margin of safety, and whether or not you agree with Wall Street that given the minimum upside, you may want to wait for a pullback. As always, if you enjoyed the episode, smash that like button. It really helps the channel grow to other investors out there. Subscribe if you enjoy the content to be continually notified of these videos as they come. And as always, see you on the next one.